Hey, welcome to the Weekly HODL with Shibs, where I bring you weekly Bitcoin adoption news and interviews from experts in the space. This week, I'm fired up to be joined once again by CJ Constantinos. To be completely honest with you, this interview is just fire from start to finish. He touches on everything from the recent CPI print to the effects of the Bitcoin ETF, the potential for new Bitcoin backed investment vehicles, and he builds a strong case for how Bitcoin will redefine what is considered the risk-free rate by the globe. He gives us some insights on his business that he's building that capitalizes on his thesis of Bitcoin as the pristine collateral. And if you're able to stick around all the way through the interview, he even gives some opportunistic market tips about the upcoming halving cycle. But as always, the show's just for entertainment purposes only, so make sure to do your own research. But without further delay, here's my interview with CJK. Hey guys, so do you remember FTX, Mt. Gox, Celsius, along with many of the other exchanges that have failed over the years? Exchanges present a level of counterparty risk that you need to take the time to understand. If you're still counting on an exchange to protect your generational asset for the long term, stop. Take some time to do your own research, choose a hardware wallet or multi-signature setup that works for you, and stamp your backup phrase in titanium with Stampseed Stamping Kit. Go to their website at stampseed.com and use weeklyhodl15 for 15% off your entire purchase. Hey, CJ, welcome back to the Weekly HODL, brother.
Hey, thanks for having me. It's great to be back.
Yeah, thanks for joining. How has the bear market been treating you?
Oh, baby, this has been the best bear market of my life. If you're in Bitcoin, you're not excited right now. I don't know what the hell you're looking at. You're following the wrong accounts. You're listening to the wrong people. There is something that is structurally different about this marketplace. The levels of liquidity, the size of the market makers stepping in. We're going to go to the next level for sure. If this is the cycle, we make a big move.
Yeah. I mean, I started to get really bullish. I made my last week's episode and just looking simply, we could talk a little bit about the ETFs, but looking at the inflows of the ETFs as the grayscale sell-off begins to kind of dwindle, it's like, holy crap, this might be way more than everybody was thinking, right? We had like a sell-off of about $8,000-9,000, and after 2 or 3 days, we're all the way back up to like 2-year highs. So with the ETF stuff, man, what does that mean to you? Like how has that how has that kind of impacted your thought about Bitcoin and where we're going?
Yeah, well, there's no doubt that last time I was on your show, Bitcoin is digital gold, right? The big boys are now just starting to figure out, oh man, they were right. It's digital gold. But they didn't listen enough because they're still listening to the digital gold people. They completely are ignoring the digital collateral, which we talked about last time. Bitcoin is evolving from digital gold to digital collateral. There is no doubt in my mind over the next halving cycle and maybe one more after that, we're going to be running towards the market cap of gold. I mean, that's where we're going. It's being institutionalized right now as digital gold. But what people need to realize is that after we reach the digital gold stage, look at what happened to gold. Gold was institutionalized and then it became collateral. Well, it failed in certain aspects of that acting as collateral. It was hard to settle, expensive to secure and move around, and it really couldn't do what it needed to do to act as collateral. That's one of the big reasons that US Treasuries came in as that tier 1 collateral asset. And now, after Bitcoin is being institutionalized as digital gold, the next step in the process is for Wall Street to realize, oh my gosh, we have our foundations of finance crumbling before our eyes. We need something here. So if we embrace Bitcoin, if we bring Bitcoin into the system and call it what it really is, the most pristine form of collateral in the world, we might actually have some fix here to actually keep this foundation standing. So I think we're at a really interesting point in the marketplace where if TradFi rejected Bitcoin, we'd watch it crumble. Instead, it's going to try to swallow it up and almost unknowingly, it's like the vitamin that it really needs. It's going to bring back reality. It's going to ground us back in equity and a truth-based marketplace. And it's like the Trojan horse to these guys, and they're desperate for anything at this point. They're bleeding out. They need something. Um, you can see what happened today with CPI and interest rates starting to move back up. I mean, we're not even above that critical level that I identified, I think, like 6 months ago when we were first talking about this. We're now approaching that 4.335% level on the 10-year, and it took 8 days to get there. That's like warp speed for the treasury market to move
Yeah.
that many basis points. I mean, Bitcoin moves like that, and these people got scared. They're like, it's too volatile. Well, treasuries are moving with the same type of volatility at this point. So Bitcoin is truly evolving from that digital gold $12 trillion, $14 trillion market cap to digital collateral, which is 100 plus trillion-dollar market cap. So if we're staying a step ahead of the narrative, if we're staying a step ahead of the general understanding of what Bitcoin is and where this is going, it's digital collateral. It's the most pristine form of collateral in the world. And if there's any glue that can hold the foundations of TradFi together, it's Bitcoin itself.
Yeah, yeah. We were talking before we jumped on here about Bitcoin being this pristine collateral, and what that means to a lender. Can you talk a little bit about the de-risking nature of Bitcoin versus other type of collaterals?
Absolutely. And that's part of the confusion here. Part of the confusion is that Wall Street is still like, well, this is a risk on asset, right? Fidelity is like, well, we're going to add 1% in our conservative, and 3% in our risky. And that's amazing, by the way. So this isn't just about fund flows coming into the ETF. Now you have different ETF products, different bundles and different designs and strategies that are going to incorporate Bitcoin at that 1 to 2 to 3% level. But eventually everybody will come to the understanding that what the BlackRock report that they reported a couple of years ago, 85% plus is the optimal allocation, not 1 to 3%. But this is how things start, right? At first it's a scam. Now it's digital gold. At first it's 1 to 3%. Then it's the most pristine form of collateral in the world. And some of the products coming down the line, I think we're going to see, like when Elon Musk went and bought Twitter, he raised a lot of money from his group of people, but he also borrowed against his Tesla shares. So that gave Tesla, Tesla just can't go up and go down. There's trapped equity there, and he was able to tap into that equity by borrowing against those Tesla shares. Well, some could argue that Tesla is overvalued. The ratios don't make sense, and there might be a lot of risk there for a lender. So what about Bitcoin? How could Bitcoin play that role? Is there a way that we can tap into our wealth that we've been disciplined enough to save in the internet economy to have real world benefits? And the answer is yes, there is. And there's coming down the line many different products. Specifically, we've been stealth building People's Reserve, for the last couple of years. And one of the flagship products that we're most exciting about is what we call the self-repaying mortgage. And, the only difference between a mortgage and a self-repaying mortgage is that the person who has a self-repaying mortgage, they post Bitcoin as pristine collateral. And we as the lender are saying, wow, Bitcoin is not a risk on asset. Like you said, Bitcoin is a de-risking asset. So yeah, you want to come borrow $500,000 to buy your home. But the difference is it's not just based on your promise. Now it's based on the fact that you were able to deposit Bitcoin collateral as well. Well, what that does is it reduces the risk for the lender. So interest rates should be a direct correlation to risk. The higher the risk, the higher the required rate. The lower the risk, the lower the required rate. Well, you as a borrower, when you post Bitcoin collateral, you're lowering my risk as a lender. So what we're doing is we're doing what everybody else is refusing to do. And at least right now, give it another cycle to everybody will be doing it. And we're recognizing Bitcoin for what it is, the most pristine form of collateral in the world that reduces our risk. And when you reduce our risk, we can reduce the amount of interest that you have to pay in order to borrow that money. It really is that simple. And it's just going to take a market maker to step up and recognize the truth. And I think People's Reserve will have that first market mover advantage as everybody else soon after tries to copy what we have planned, not only for self-repaying mortgages, but for a few other cool ones we got up our sleeves as well.
Yeah, man. I mean that's huge stuff, right? Like if this is something that takes off, like not only for for Bitcoiners, but for just competition in the existing traditional finance world, right? And I think one thing that we've all learned as Bitcoiners is to understand counterparty risk. And when you're talking about the collateral that traditional finance is used to taking on, a lot of what they're not really understanding is, or the risk that we see is that the entire system is underpinned by a bunch of bullshit right now. So it's like, it's great that your Tesla stock is high, or your Apple shares continue to go up, and again, we've got PE ratios that are absolutely astronomical right now. But we all have that feeling, that pit in our stomach, the soft landing that they're talking about, like that this isn't coming, and maybe we can get away with kicking the can one more time. But when this stuff crumbles, where's that collateral now? What's that collateral worth to those people, right?
I love what you said there, though, when you said that the marketplace views the counterparty risk. And right now, the best counterparty in the world is the United States government. That's what people use for the risk-free rate, a treasury bill. It's got the lowest duration risk, and it's got no credit risk, because you're definitely going to get paid, right? But now people are starting to realize, there is a risk. It's called inflation risk, because I know I'm going to get paid, but when I get paid, I don't know what the hell I'm going to be able to buy. So what we're going to see is a transition from the least risky counterparty in the world being the US government to being Bitcoiners, because Bitcoin is a commodity credit. It's a credit market based on equity, not a credit market based on debt, which debt requires inflation. Remember, Bitcoin falling into this, it did what gold and US treasuries could never do, right? Gold was hard money, but it was too cheap to secure and to settle. But treasuries were soft money, but they were super cheap and easy to settle. Well, now we have a hybrid. Now we have the best of both worlds. We have hard money that is also cheap and easy and secure to settle. This is the natural evolution of finance, and Bitcoin is on the forefront, with People's Reserve being the tip of the spear with these products that are going to recognize Bitcoin as that most pristine form of collateral, empowering Bitcoiners to be the least risky counterparty in the world, not governments.
Yeah, that's crazy. So how long do you think something like this? I mean, this is true, like when people say like hyper Bitcoinization, or products that would lead down the road to opening people's eyes to why the world should hyper Bitcoin eyes. This product would highlight that. How long do you think something like this would take to catch on? I mean, obviously with Bitcoiners, they'd look at this, and as long as, again, going back to counterparty risk, right? As long as you had some sort of model that assured that they couldn't get rugged, some, multi-signature, multi-custodian solution where they still held one key, maybe you guys held one, like kind of like an Unchained Capital type of thing.
Escrow. Yep. Absolutely.
Yeah. As long as there's some ability to do that, Bitcoiners seem like, they would be all over it, right? Because if you can get, like, let's say interest rates begin to come down, Trump becomes president, fires Powell, forces whoever, the new person is to come in and lower interest rates. Interest rates come down, mortgages come down, 4%, 3%, something like that. You're lending out to Bitcoiners at 2% or 3%, a percent lower, or, a couple basis points lower or whatever. And how long do you think the rest of the world takes to see this? Or do you think that this is, do you think this brings additional attention to Bitcoin as a pristine collateral? And do you think traditional finance, how do you think that they receive this type of competition?
Yeah, I think
really
it's going to build. No, you're fine. I think it's going to build up demand on Bitcoin as people can see there's more use cases for it. Right now, Bitcoin is digital gold. It's savings technology, right? It was strategically designed and engineered to leverage the natural laws of economics and commodity cycles and price discoveries to empower we the people. And that's fantastic. And that's all it needs to be. But because we live in a world that's been modernized and financialized, there are additional applications. And I think businesses are going to be borrowing against Bitcoin on their balance sheet. I think people are going to be borrowing against Bitcoin to obtain higher assets or cash flow, make cash flow investments. And Bitcoin is going to be what empowers them. So I think it's going to build demand. But what I like to do is I like to look at things from both sides of the issue. And I think most people just naturally look at it from the borrowing side. But really, the main interest here is going to be to the lending side, because what is happening undeniably is that the dollar is in an inflationary debt spiral, and the deflationary recession or hyper recession that people are hoping for. If that was going to happen, it would have happened back in March. They created the bank term funding program so that wouldn't happen, right? What better way to reduce the amount of circulating money units than to let credit just crush and destroy itself? Because when that credit evaporates, the money supply dwindles. That's deflationary. So if they wanted to bring about a deflationary cycle, they would not have created the bank term funding program. They would have not kept slapping on these band-aids. And who knows, a couple other off-balance sheet tricks that they've been doing with a few other smaller name lending windows that most people aren't familiar with. But the numbers get up into the billions because the banks don't have our money. Assets are less than liabilities. It's just, that is the reality. And if people wanted their money, they couldn't get it back. So it's really important for them to control that narrative that, hey, your money's safe, it's insured, it's okay, you don't need it right now, because they're hoping, when interest rates go down, then price of the bond goes back up, and, we'll be able to we'll have more assets against those liabilities. I'm not sure they're ever going to go to where they need them to go, because remember, they were forced out the yield curve when the rates were zero, right? So federal funds effective rate was 0 to 0.25. And that's what forced the banks out the yield curve to the notes and to the bonds to get the yield. And then they got stuck with it when they raised rates. And now everybody thinks the rates are going to come back down. The rates should come back down. This really triggers people, but lower interest rates actually means lower inflation. I know people are like, well, wait a second. How can that be? Because the source of inflation is fiscal policy. That's why. Because we have $34 trillion in debt, 211 trillion unfunded liabilities. And look, guys, it's common sense. Does it require more printing of money to borrow 34 trillion at 5%? Or does it require more printing at 34 trillion at 1%? Right? Yeah. It's common sense. So because the fiscal policy is the main source of inflation, not the economy, right? We're actually in an inflationary recession right now. The economy is shrinking and prices are still going up, and people are confused. And I always tell them, look at Venezuela, look at Argentina. You can crush the economy. You can murder the economy. You can kill the economy. I mean, there can be no demand except for the basic essentials of food and water, and prices will still go up because the economy is not the source of inflation. It's the fiscal policy. It's the devaluation of the currency that is forcing the prices to go up. That's what's happening here. Sure, the economy does create a price pressure through the supply-demand equilibrium. That's a natural law of economics. But also another natural law is that the other half of that transaction, the currency side of that transaction, supply-demand applies there too. If the supply of that currency is going up and the demand is staying flat, the value of that currency, the purchasing power of that currency is going down. So, I say all that to say this. What people are going to come to realize is the governments are not the safest to lend to anymore. So when the big boys, when I say big boys, I mean when the big market makers come in, right? I think money market funds right now have over $5 trillion in them. And everybody wants to lend to the government because, hey, it's risk-free. This risk-free lending to the government paradigm is going to break down. And it's not going to break down because people aren't going to get paid. It's going to break down because when people get paid, they are not going to have increased purchasing power, right? If you started buying these things as they were raising rates, you would think to yourself, oh man, I'm getting 3%, I'm getting 4%, I'm getting 5%. I can buy more this year. Uh-oh. No, you can't, because real inflation, not CPI, real inflation is 10%. So people will realize that. It takes some time, but they'll realize that. And this, smart money too. Yeah,
this is something I think about too. It's also a little bit of a generational thing, right? Because we've got baby boomers that have, whatever the large percentage of the money in circulation is. And so when they're getting kind of bled bled out through this inflation, whether or not they're getting, they're getting their 5% in a money market fund or something like that, 4 or 5% in a money market fund. They actually look at it like it's a good thing because they're sitting on nest eggs that are, way higher than the millennials or anybody younger. And so when the millennial generation looks at these returns and they actually understand the principles of inflation and they're feeling it right when they go to the store, like this is not a viable option for them, right. and they realize it, right? So how long, again, like how long do you think this transition takes? Like I almost think it takes a portion of the generations kind of passing away and
Right. Well, if you told me that the government was going to print trillions of dollars and just send us paychecks, I'd say the time is at hand. We've now reached it. We've now crossed and I think we have. When you look at the data, 2020 is that very clear point on every chart that something changed. The market dynamic changed. And the truth of the matter is it just takes time. It's like when you first get into Bitcoin and then you buy your first shitcoin. And then it goes down 99%. And you're like, oh my gosh, well, you know what? I'll just hold it because in the next bull cycle, it's going to go back up and I'll get it back. Maybe I'll even make some money here. Like that's the mindset that these guys are stuck in. The mindset is, well, it can't be like this forever. It's a paradigm and that paradigm is going to break. And fortunately, I think for the smarter money, for the market makers, they call the bond vigilantes, the smart money, right? They front run the Fed. Well, when you're talking about managing huge swaths of money. And I mean, I don't even qualify because I'm talking about like trillions of dollars, not billions of dollars. So there's a big difference between $1 billion and $1 trillion. And if you're not at that level, you don't understand. So I'm sure, there are some things that I'm missing. But at a 10-digit level, it's one of those things where it's like, hey, we have money. We don't want to lend it to the government. I mean, we can't lend it. The math is telling us we can't lend it to the government. I don't really trust the corporations because I think they're overvalued. So I don't believe, that all of that equity value on their balance sheet is pretty much just as good as FTX's FTT tokens equity value. It doesn't really mean anything. It's just a number. It's just a blown up number. It's part of the bubble. And real lenders are going to start to, real people who can't print money, like the banks won't care, right? But real people who can't print money are going to start to care. And they're going to start to care as they feel that squeeze from inflation more and more. So I guess I'm kind of dancing around the question. I don't have a timeline because, and you know what? The product doesn't exist. I think once our product goes live and we start to tranche these mortgages together, and instead of having like a mortgage-backed security, maybe you have like a self-repaying mortgage-backed security, and you have different tranches of Bitcoin collateral that forms a commodity credit, an over collateralized credit market, which is not even a credit market, it's a commodity credit market. And when they see the opportunity to invest there, to put that 1 to 3% there, just in case something happens with the government, I mean, that's how it's going to start. We'll put a little bit in, and then over time it will prove itself better. So it's going to take a few cycles. It's going to take some learning. It's going to take some of those bigger ups finally retiring. And getting some new young blood up in there with some fresh ideas. But ultimately, I think math drives the smart money, and the math is on our side.
Yeah, for sure. Something you kind of reminded me of while you were talking. You reminded me a little bit of Berkshire Hathaway and listening to Warren Buffett over there talk about and how patient he is, waiting for the right time. They sit on so much cash, right? Like they sit on a ridiculous amount of cash, and he goes, well, everything's just overpriced, so he's looking at the market. He's like, everything's overpriced. He looks at, I think they made some moves to China, but now they're feeling the counterparty risk that's involved with China in many different ways. And I'm sure they're looking at it now going like, well, that risk, of market collapse because the underpinning money is getting devalued and the amount of debt that's in the system, like that same thing exists here. So I don't see how those people don't begin to look And they were never gold believers, right? Because gold doesn't have an asset, doesn't have a balance sheet. But it's
Right.
like, where the hell do you put money when
Yeah.
when there's so much money in circulation that everything has gotten overvalued, inflation is rampant. There's just an underlying risk of collapse that's there. And it just seems like, Bitcoin is, um, shines in that
Right.
light.
It's the solution. It's the de-risking solution. Why keep all that cash on your balance sheet when you can lend it out with Bitcoin being used as collateral? I mean, talk about turning a sunken asset, like a depreciating asset on your balance sheet, into now a cash flow asset. I mean, I think it's kind of these newer financialized products that evolve Bitcoin from digital gold to digital collateral that actually have the chance to capture the attention of a Warren Buffett or an Apple or somebody who's sitting on, billions and billions and billions of dollars, and they don't want to sit on it anywhere else. They don't even want to lend it to the government. They might hold it in cash equivalents, but we're talking like money market fund cash, so that they can be at the Fed repo window. Every
Yeah.
single day it's a new contract, or every single week it's a new contract. These people aren't buying 3 months because even that duration risk, at some point, the yield curve has been inverted for so long now. It's like the smart money is saying, hey, any second we're going to be right. Any second we're going to get this deflationary event. And we could, but it's the reaction to the deflationary event that needs to concern us, because again, bank term funding program, they're not going to let it happen. They're going to slap on the next band-aid, slap on the next band-aid. And sometimes it doesn't even need to be a band-aid. Look at all the money we're sending to these other countries. I mean, it's people are really starting to get fed up. And I know, I said this before, but in my studies, I've come to this conclusion because I feel like it's impossible to answer that timing question, right? People always ask, well, how long is it going to take? No,
Everything
because
takes longer.
yeah, the only difference between inflation and hyperinflation is trust. And that's the most important metric, because once trust is lost, it's not going to be gained back. Now, trust can be lost by trying to introduce a CBDC. Trust can be lost by abusing the printer privileges like we are now. There's many different things that could lead to a loss of trust. But once that trust is lost, there's no getting it back, even if they end the dollar and launch a CBDC, kind of like in Weimar Germany. They created a new currency and thought that was going to reset everybody's mindset. It didn't. It accelerated it turned it into hyperinflation. So the only difference between inflation and hyperinflation is trust. And right now, it just seems that the government is doing everything they possibly can to deteriorate and break down that trust. Not only that, but I don't want to get too political, but when you look at the border, now we have a dispute between Texas and the federal government, and Florida and Arizona are sending National Guard. And I mean, it's like a common sense thing because it's already black and white in the law, right? We just need to enforce the law as it is. And if you want to
Yeah.
change the law, that's fine, change the law. But we have to enforce the law as it is now. And it's black and white. It's easy to understand, and we can't even come to an agreement. So what would happen if Texas started just not what if Texas came out and said all Texas residents do not have to pay federal income tax, but they should be paying the Texas federal stipend income tax? And then you redirect what would go to the federal government income tax into the Texas income tax, not just like a state tax, but like a special federal stipend income tax, because people are saying, that's it. I'm not going to give my money to them when they're turning around and giving it to these people coming across the border. They're getting healthcare, they're getting education, they're getting food. They're not building the wall. They're not keeping us safe. They're breaking the law. You know what? I'm not paying into that anymore. I'm going to pay it up to my officials who I voted for, and they can spend it to defend me and my family. That's a big risk to U.S.
Yeah.
treasuries. Again, it's an inflation risk because they're going to have the money. But if Texas stops diverting its taxes, or exempts its residents from having to pay that tax, and says, we'll legally protect you. We're not going to extradite you. We're not going to let them come after you because you're paying those taxes to us. And then a couple other states join in and do that. I mean, when you look at the Civil War, the first thing that happened was the currency, right? Even Abe Lincoln, I believe Abe Lincoln was murdered because he created the greenback. He created a new currency issued by the Treasury and not the banks. So a lot of these things really come down to finances, and because when the relationships start to fall apart, the counterparty risk increases. And when counterparty risk increases, what are you to do except work with the people that you trust? And Bitcoin, of course, offers a trustless way. So the states don't need to create a new system and build trust from zero. You can work trustlessly with Bitcoin, and you can incorporate this into that's a huge risk for treasuries. If that idea, I mean, I almost hope that idea never comes to be because of the amount of risk it would introduce to the system. I want stability for the sake of me and my kids, and to be able to live free and have free speech. I don't want to go through this time of complete societal breakdown. It's not going to, if that happens, you don't want to be here. It's not going to be safe to go to the grocery store. You can't take your kids to the park anymore. You're not going to want to be in this country if that happens. So I'm hoping something like that doesn't happen, but it's a reality that is a potential outcome. And people should know that, hey, if some of these states get more organized against the federal government, the U.S. Treasury is going to have to print even more dollars to make up the difference to pay the yield on these 5% and 6%. And even if it goes back down to 0% and 1%, to print all the money to pay for the unfunded liabilities, $211 trillion. There's no way out of this. It's, do we want inflation or do we want maximum inflation, which could cause a loss of trust and spark hyperinflation? There is no deflationary option on the table for these guys right now. So we all need to opt out of clown world and protect purchasing power with Bitcoin.
Yeah, for sure. Wow. Yeah, I've entirely never thought about states' rights to do any of that stuff or their propensity to do any of that. Have you heard anybody actually talk about that in Texas?
No.
I've never heard anybody murmur that before.
No, I've never heard anybody talk about that, but I get that from my studies of the Civil War. I find it very interesting that the banking and currency fight that went on in the Civil War was almost more important, I think, because now you're talking about paying for your military. Why'd the South do it? Because it's like Russia; they're cut out of the system. You force them to move to a new tool, to use a new currency, because they got to pay their army, they got to pay for supplies. It's now become its own economy, and I haven't heard anybody talk about that at all. But it's just something that I think about as part of the risk of lending to the government, because it increases the inflation risk. Because if the federal government continues to ignore black and white laws that are plain as day, this could come back to bite them. And I don't want to be stuck in that market. I mean, I know Janet Yellen says the treasury market is the most liquid market in the world, but I'm telling you, Monday through Friday from 9:30 to 4 is not the most liquid market in the world. 24/7, 365, Bitcoin is the most liquid market in the world. That's right.
Yeah, buddy. Oh man, amazing. So one of the reasons we reconnected, you had an exchange back and forth with British HODL on Twitter regarding Bitcoin ETFs and some of the different investment vehicles that are kind of coming out. One of them being a yield generating Bitcoin ETF. And my question, of course, when I hear the word yield, right, when Bitcoiners hear the word yield, is like, well, where's the yield come from? And your guys' discussion was kind of about like how this is big for Bitcoin. So if you wouldn't mind, can you talk a little bit about that? Again, this seems like, like the goes back to Bitcoin being the best collateral, I assume. But if you could speak to it a little bit about how that vehicle would work, and then what the impacts are for Bitcoin itself.
Yeah, absolutely. So, this is one of the rare circumstances where yield is actually good. And it plays less into Bitcoin being pristine collateral and more into the fact that people who are involved in the stock market like to speculate a lot. And the speculators, they trade what's called options contracts. So you pay for an options contract, what's called a premium. And you pay that premium for the right to, if you're making a call, most people will sell covered calls, meaning they have the ETF shares. Usually there's 100 shares in a contract. So you have to buy at least 100 ETF shares. And that will allow you to sell one options contract. And a speculator who is speculating that the price of that ETF share is going to be higher than the price that the strike on the contract. So let's say like IBIT is at $30 and you sell this person a $50 strike. for $100. Well, they're going to end up paying a significant amount of money for the right to buy those shares. And $100 is probably a bad example. Let's say like $10, because that's going to be $1,000. So they'll pay you $1,000 premium up front for the right to buy your shares for $50 at the time of expiration of the contract. So see, the yield is being paid by the speculators to the people who own the shares, who are selling the covered calls. So this is a form of sustainable yield that doesn't require printing. It doesn't require any type of weird rehypothecation schemes or anything like that. This is just speculators want to bet that the price of the ETF share is going to be higher than the strike price at the time of expiration. And they're willing to pay a smaller premium to get their hands on those shares. So in this example, if IBIT was at $30, this guy's paying $1,000 for 100 shares, but 100 shares cost $3,000, right? So he's paying a significantly less amount of money for the right to buy those shares. And if the shares are above that price, well, of course he's going to buy them for the strike price at 50, because then he can turn around and sell them on the market for 60 and profit. But if the shares don't go up as high as 50 and it's like $40, well, of course he's not going to exercise the contract, because why buy them for you for 50 when he can buy them on the market for 40? And then the ETF owner can write another contract and collect another premium payment for those 100 shares. So that's what the Bitcoin ETF yield generating strategy is. It's about buying ETF shares and then selling covered calls back to the speculators in order to generate yield on those shares. And a lot of the big market makers love this type of setup, because I'm not going to say you can get delta neutral, which means that the movement of the price doesn't matter. Like if price went up or down, the value of your position would stay the same. That's not necessarily what people do here, but you can hedge downside as well. And it does squeeze a little bit of that yield down. But when you're a bigger market maker, when you're talking about these types of yields, look, you have $3,000 worth of shares and you're getting paid $1,000 up front. So that's a significant yield. Yeah. And the premiums that people pay in Bitcoin, because the implied volatility is higher, right? So you look at some of these strategies on other stocks like Apple or Tesla, they don't perform as well because the stock is limited in how much the market perceives that the price can move up. So people aren't willing to pay that high of a premium for the call option. Well, that's not the way it is in Bitcoin. Ingrained into Bitcoin is this story of volatility, which is displayed and made true. But what that does is when price right now is at $50,000, it allows somebody to say, hey, I think by next February, price is going to be at $100,000. There's no stock that exists that people think is going to be up 100% and they're willing to pay a call option for it, right? It just doesn't exist. So the implied volatility of Bitcoin really helps drive those premiums up. So these Bitcoin ETF yield generation strategies are attracting the attention of the biggest market makers in the game because the speculators are willing to pay the biggest premiums in the game because the implied volatility is the largest that there is in the game. So the stars are aligning for this strategy to outperform any other covered call strategy in the marketplace and to do it consistently because of that consistent volatility of Bitcoin being number go up technology.
Yeah, gotcha. So you think that this is and so is there a way to invest in, like, would there potentially be a way to invest in that yield generation? So if somebody was like trying to be conservative, they didn't want to buy Bitcoin, but they just wanted some sort of like, is that the actual vehicle, or is the vehicle just that people are able to, the market makers, I guess, are able to make this yield?
No, there'll be a yield generating ETF. So instead of buying the ETF straight up, you can buy into the yield generating ETF, which uses those practices and maybe a few others to generate the yield. But now you're going to pay fees. There's management, and if you're willing to do it, most people aren't going to be able to do it. But if you're willing to pay attention and do it, the best way to do it is just go buy the ETF shares yourself. Just go buy in blocks of 100. And then when things get super euphoric and the cash register at the grocery store is telling you about Bitcoin, sell some covered calls, right? The best part about a covered call is, especially for market makers, right? For an individual who's speculating and wants upside price movement, it's not there because the covered call limits you, right? If I bought it for 30 and I'm selling that $60 strike price, the upside is limited to 100%. So if Bitcoin blasts through 100,000 and goes up to 200,000,
Yeah.
I still got to sell it for him at that $100,000 level. But I
Yeah.
was able to collect the premium. But as a big market maker, I just made 100% plus the premium. I'm happier than a pig in shit because you're not getting these numbers anywhere else with this type of size of money and this type
Yeah.
of risk. So it's all proportional, right? There's a difference between retail and institutional. There's a difference between a hedge fund and a market maker. And we're now talking about the biggest market makers in the game entering the industry. And the first toe that they're dipping in is going to be through a yield generation strategy, such as we just talked about, selling covered calls with a
Yeah.
Bitcoin ETF.
Yeah. That's the possibilities seem wild, right? When we talk about counterparty risk in all these different areas and the options of buying treasuries and things like that, when you have products that are like this, when you could store a certain percentage in something like this, it puts a lot of pressure everywhere. Yeah,
it's gonna people on Wall Street will not be able to respond. I think some of the people who think they're more sophisticated, behind closed doors, they're just going to be like, well, people who bet on Bitcoin are idiots and they're willing to pay large premiums and I'm willing to collect them, right? And they'll kind of like make fun of them. But after they see that it's sustainable and it's continuing, I mean, it's why allocate your money into a money market fund when you can be in a Bitcoin income strategy with limited downside and higher risk? I think what we're going to do ultimately is we're going to redefine the risk-free rate. And some of these products are going to start stemming out and saying, hey, yeah, we're not pumping out 5.5%, but also we have much lower risk. So would you take 4.5% with much lower risk than you would take with 5.5% with all the inflation risk of the government, with all of that spending and debt hanging over them? The inflation risk is all but guaranteed. In Bitcoin, with speculators and yield generating strategies, there's lower risk with almost the same guarantee. And if they have to lower rates, then it'll be a much better risk reward. This little short window of where rates are now, because I do believe they're going to be forced to lower the rates for all the reasons we talked about earlier. The rates should go higher, but they literally cannot, because the higher the rates go, the higher inflation goes, and the whole narrative breaks down. So they're in their sweet spot right now, and I think they're going to be forced lower. But that's going to make what we just talked about even more attracted to all these people. Because now you got $5 trillion that's going to sit at 2%. No way. That $5 trillion is going to come rushing back into stocks. It's going to come rushing back into Bitcoin. It's going to come coming back into real estate. You got all these people sitting on the sidelines. When they finally realize that we're not getting some hyper deflationary super depression, and that we're already in an inflationary recession, right? The economy is slowing down, the prices are going up, yet the quality of life and the standard of living are going down. This is an inflationary recession. This is how it works. This is why it's so confusing. So they're waiting for this hyper deflationary 1929 Great Depression, and we're already in it. But the crash happens to the upside, not the downside. And when they start to figure this out, especially when they lower rates and a lot of that money starts to move, one metric I love watching is monetary velocity. Monetary velocity is increasing. It's not just ticking up a little bit. There's a trend change. There's a trend shift. And this is a very long trend, and it's now shifting, and velocity is increasing. And when they lower rates, velocity is going to increase even more as that money races to get to where it perceives itself being the safest. And when that happens, products like the Bitcoin ETF yield generating strategy are going to stand out to people saying, oh my gosh, I can get 4 or 5%. And, they're not delta neutral, but the risk reward here, just look at the math, look at the numbers. This is where it makes sense for me to park 3 or 4 or 5% or 10%. And those not just like the BlackRock, not the spot ETFs, but also these ETF yield generating strategies are going to find themselves getting allocations into these bigger ETF structured portfolios.
Yeah, absolutely. So who's going to have all the shares? Who's going to have all the Bitcoin, man? So,
Yeah.
dude, I haven't felt this bullish. So I got in 2020, um, and really started learning, I would say tail end of 2020. And so I got like the full feeling of euphoria, got the whole like, this thing's never going down. Like we're up only.
The
Pretty awesome,
psychology of
right?
the market cycle, right? The
Yeah, I
psychology of the
was
market
it,
cycle.
right? Like I was exactly every portion of it, right? Fear and greed index, I live it, right? Like that's me. And what's interesting about this cycle is that I went through the bear cycle, which I feel like it just feels like a blessing that I got the opportunity to really learn and grow my conviction. I'm now starting to feel like as bullish as I did at like the peak of the last cycle, and we're on like the very beginning, right? We've got this set up like we're talking about of the potential for lowering interest rates, money flooding back into risk assets. And we've got another event that's on the horizon that I'd like you to talk a little bit about, which is we've got a halving this year. And so I think most of the people watching probably know what it is, but if you wouldn't mind just touching base on it and what you think the impact is going to be and how you kind of put that in perspective for yourself.
Absolutely. So yeah, everybody watching the show knows the halving cuts the mining reward in half and it creates a supply squeeze, right? Because there's all this demand. There's this net inflow of funds flow coming in. And then now instead of 900 Bitcoin, there's only going to be 450 Bitcoin. So when you have increased demand against a declining supply, the natural laws of economics tell us that the price is going to go up. That's all true. And that is a fantastic reality for Bitcoin. I like to look at it from the other angle, which is the cost of production angle. Because, yes, it's true. There's going to be increased demand against less supply. Absolutely. But what this does is when the price to produce, or to, as Satoshi said, the price to generate a Bitcoin doubles, it changes the natural asset value of Bitcoin. The natural asset value of Bitcoin is based on its cost, and that's a natural law of business. Because to run a successful business, you're a good businessman. Look, you can't go consult with people and charge them less than what it costs you to provide that consultation. You'll go out of business. This is a natural law of this is business 101. If you're running a business
Yeah.
and you're not making money, shut down your business and go get a job, because at least you'll make some money, right?
Or
So
take a loan out at 1% and
yeah.
run it ongoing forever.
Yeah, or start a zombie company, right? Like
Yeah.
that's like acceptable. That's a lot where the disconnect comes from. Up to 12% of publicly traded companies in the United States are zombie companies. They would have never scaled. They would have never grown if they couldn't borrow the free money. And now that the rates are going up and they're refinancing, they can't even afford. They don't even make enough money to pay the debt that they took out to grow their business, because the value proposition of the products and services that they're offering is not equal to the price that they're charging. And people don't want to pay a price above the value that's being delivered. So that's what's amazing about the halving for Bitcoin. Yes, the supply demand dynamic is true. But when you look at cost structures, which is one of my favorite forms of analysis in real estate and commodities, especially Bitcoin, the Bitcoin is the only asset in the world that can raise its own floor price. Gold can't make itself more expensive to mine. Silver can't make it. Oil, there is no other asset in the world. I'm struggling with a word to call it. There is no other thing in the world that can make the floor price, the marginal cost of production, go up on its own. And Bitcoin, through the difficulty adjustment, makes this happen. So the halving increases costs every 4 years, roughly. And then every 2 weeks or 2016 blocks, the difficulty adjustment is going to kick in. And that, if the network is growing, which it has been growing exponentially, I highly recommend people go check out my exponential network hash rate growth tweet, because it's sobering. The Bitcoin is truly a quantum computer ledger. There is no other computer that can compete against it. There's no quantum computer that compete against it. It is the quantum computer, and it is the quantum accounting ledger. And that affords tremendous amounts of safety into the asset itself. So the amount of hash rate we see going into Bitcoin, the way I say it is like this: price drives hash rate. Well, why is that? Well, because when the price goes up above the cost of production, that creates profit. And when the miners profit, they reinvest their profits in more hash rate so that they can profit more, right? So it's a positive feedback loop. So price drives hash rate. Hash rate drives difficulty because the increased hash rate allows miners to find blocks at a faster than a 10-minute pace, which then triggers the difficulty to increase, targeting that 10-minute block time. And then as hash rate drives difficulty, difficulty drives cost, because when that adjustment takes place, the cost to generate a Bitcoin increases. That means, just like for your business, if your cost increases, then your front end line price has to increase. That cost needs to be pushed to the person who's experiencing the delivery of value. For the person who believes in the value proposition of that good or service, they must now pay a higher price, a price that is above the cost, or else the miners, the way it happens in a traditional market is the supply goes down. Now with Bitcoin, that can't happen, but the supply will go down. And then as supply goes down on a consistent or growing demand, price goes back up. And then price goes back up above cost, and then producers hop back in. So we could take that traditional commodity cycle and learn from it in Bitcoin. Yeah, there are some differences, but the value proposition of Bitcoin is determined by its cost. And the value proposition of Bitcoin is self-sovereign quantum ledger money. There is nothing else that can make a better value proposition. Bitcoin fixes this, right? Bitcoin solves this. Like, why? Because money is the number one most traded commodity in the world. It's 50% of every single transaction in the world. It is the largest commodity with the largest base layer of demand because it's 50% of every transaction in the world. So the base layer demand on Bitcoin is going to be bigger than anything else because Bitcoin is money. And we can take that base layer of demand and say, since we have a base layer of demand, right? Because if you dig your hole in the backyard, nobody wants your hole. It doesn't matter if you blood, sweat, and tears and you spend $100. The hole's not worth $100. Nobody wants it. You need a base layer of demand. Well, Bitcoin generates its base layer of demand by providing the most important value proposition in all of the world. So we have a strong value proposition that's worth whatever the network says it's worth, right? Because there is no other option for self-sovereignty. There is no other option for truth money and freedom. So the value proposition is going to be tied directly to the halving and the difficulty adjustment. And the fact that we're coming up on the halving, it's just really exciting because it's part of Bitcoin's engineering. It's part of Bitcoin's genius and design that it leverages those natural laws of economics and commodity cycles and price discovery to empower its holders, to empower you and me, not to empower the people who are closest to the money printers, not the cantillionaires, but the everyday we, the people who are able to embrace the right mindset and use Bitcoin for what it is, the best savings technology in the world, and soon to be the most pristine form of collateral in the world.
Yeah, man. You get me pumped up. I'm like leaning closer and closer to the screen as you're talking. So are you throwing a halving party or what?
I did want to do a little something with my community, but I think we're gonna postpone it for a little bit. But I think there's a good halving party going down in El Salvador. I know I'll have my Block Explorer open and I'll be ready to celebrate with the family. But it's gonna be a big move. I think, I hear a lot of people say this: Bitcoin's gonna become harder than gold. And I get what they're saying because the inflation schedule, like the rate on the inflation schedule, will be now lower than gold's inflation rate. But Bitcoin is already harder than gold. There's only 21 million. There's a finite supply. So, just because they're being issued at a rate that's being issued slower than people can pull gold out of the ground doesn't mean it wasn't better than gold to begin. It was always, from the first block, it was better than gold and it was harder than gold. But it's an interesting metric. I think it ties more into my cost structure analysis than it does to the supply demand side. So if people could connect a dot or two, maybe they could learn something. I'd have 60,000 followers instead of 6,000.
Yeah, I mean, I don't run my personal calculations on Bitcoin thinking about like 19.4 million or however many is mined at this point, right? Like I just go 21 million. It's close enough already, right?
Yeah,
We're already rounded up. There's not that much to mine left. I,
absolutely.
I'm personally have been shocked with the amount of investment that has gone into mining over the last couple of years. I was shocked originally when I went to Bitcoin 2021 or 2022. I was shocked with how much investment was there and how many there were a lot of, I would say, like bonehead miners that were kind of there that didn't even really understand Bitcoin, right? They just kind of knew that, like, the price goes up, I mine, I'm making, they're just cash flowing. They're just looking at it like it's cash instead of like Bitcoin, right? Like they just sell it immediately when they get it. And I just kept going like, well, what happens when the price goes down? Because they're all like, well, we just take on money, we take on money, we buy miners, and then we pay back with the cash flows. And I'm like, okay, well, there's a lot of people that are thinking like you. What happens, what happens when the price goes down? And now what happens when the price gets cut in half? Right.
Right.
So like, it's been wild to see that, hash rate hasn't dwindled like it has seemingly in past cycles, right? Like when Bitcoin kind of, the Bitcoin price went down and dipped, like the hash rate kind of, there wasn't people with the conviction necessarily, or
Right.
conviction in the means to ramp up at a pace like it has this last time. How do you think
Right.
that all kind of plays out? I mean, do you think that we just have a typical, like, bunch of people get washed and we see
Yeah,
a
so
dip
we
at the
call that
halving?
a minor capitulation. That's
Yeah.
what, so, after every Charles Capriel, the OG of cost structure analysis for Bitcoin. Um, Actually, he's the author of a few variables that went into my Bitcoin fair value treasury management algorithm. Um, the way that we have to think about it are the hash ribbons, right? So it's like the growth rate of the hash rate, not the actual number of hash. So the growth rate starts to slow down going into those cycles. Of course, when hash rate goes down, if difficulty is too high, then Bitcoin is what's so genius about the difficulty adjustment is that it's not just number go up technology, it's also sustainability, right? Because
Hmm.
if the, what happens when price goes down? Well, let's say price goes down below cost and now miners are losing money. The first thing they do is they stop selling the Bitcoin, right? And as the supply gets constrained against that consistent base layer demand, the price can start to recover. It reminds me a lot of the 2021 China mining ban, right? Bitcoin was ripping up to 60,000 and then China banned it. And then what happened? The miners sucked up every single penny of profit that they could, but they didn't sell it for a penny less. They didn't take a loss on their Bitcoin. They locked in all of the profit margin so that they could relocate. And then when they stopped selling, what happened? Price ripped right back up. So, miners have a little bit more control. It's not just about the amount of coins that are being released per day. It's also about the amount of coins that are built up into the treasury, right?
Yeah.
So all of those coins can hit the market, and also the coins of plebs can hit the market. If you don't understand where Bitcoin is going, $100,000 Bitcoin might convince you to sell. There's always going to be some price that, a miner's cost is going to be based on electricity, but an investor's cost is going to be based on their cost basis. So price always gets to a point to where it can convince somebody to let go of those coins. But truly, if you're selling Bitcoin, I don't think you get the full picture here, because eventually you'll just borrow against it to access that trapped equity. Why sell it and pay 20% capital gains or 30% short-term capital gains when you can borrow against it and pay 6, 7, 8% APY? You can borrow for 3, 4 years into a cash flowing business or project, and have a chance at having both the business or the cash flowing asset and still the Bitcoin, and with
Yeah.
no tax obligation. It's a no brainer. But I think, here's a little gem for all your listeners. Just my little way to say thank you for having me on. Uh, the last halving in 2020, I got 7,400% profit on this strategy, and I'm going to share it with your listeners right now. What's going to happen is you can see it in the miners right now. Everybody's super bullish, right? But after the halving, and it's very interesting the way this works because of the way that the timing of the halving, right? So we have January, February, March. Well, at the end of March, all the mining companies are going to file their quarterly reports. And those quarterly reports are going to have unicorns and stars. And it's going to be like, oh my gosh, my cost of production for Bitcoin is 35,000. I can sell it for 50. This is the most profitable commodity to produce in the world. If you're not invested in Bitcoin miners, you're crazy. Well, like you said, after the halving, that cash flow, because they do look at it as cash flow. They don't value it as Bitcoin. They look at it as cash flow. That cash flow gets cut in half by 50%. So I don't care who you are or how important or big you think you are. If your business model is now producing 50% less cash flow, you have problems. It's just that simple. So what's going to happen after the halving? Not directly after the halving, because the halving is in April, and those second quarter reports aren't going to be filed until June, and they're not going to be seen by the public in July. So for all your listeners out there, I think perhaps in July, when people see the minus 50% revenue run through those balance sheets and all those unicorns and stars and excitement turn into fear, that is going to be the best time to go ahead and load up on calls. I wouldn't even buy the shares, because why buy one share when you can pay a premium, get the right to 100 shares? I would take the furthest, longest out of date expiration and the furthest out of the money strike, and you're going to be able to buy it for pennies on the dollar, because what's going to happen is everybody who's buying the mining shares right now is going to get scared, and they're going to start buying puts. They're not going to want calls. They're going to want puts because they want to protect their position.
Yeah, they want to hedge.
Fantastic, because that means the premium is going to move from the call side to the put side. And when you see that swing, when puts are selling for a higher premium than the calls, that's when you want to start building your position. And for pennies on the dollar, you'll have the right to buy blocks of 100 shares, depending on how many contracts you buy, for literally pennies on the dollar. When this happened to me after the 2020 halving, I first used this strategy. I bought $3 riot calls, $3 riot calls for 5 cents. So it was absolutely unbelievable. It cost me like pennies, literally pennies on the dollar, in order to buy these contracts. And I loaded up. And at the end of it, I didn't even let them expire. I sold into the euphoria when there was still some time left, right? Because options have time decay. But also, when you're in the money and there's time left, it adds additional premium. You get a term premium that boosts that premium price. So that's a strategy that, if your listeners are listening to, I think that you should keep an eye on that, because you have a chance to invest a small amount of money and get a large amount of return based on the underlying fundamental dynamics of the marketplace. April, the halving cuts in, revenues get cut by 50%. By June, they have to file the reports. By July, everybody knows about it. The premiums will shift from calls to puts. When everybody's buying those puts to protect the equity value that they invested in the run-up, you're the one who's buying calls for pennies on the dollar. That is a great winning strategy to play the halving on the traditional broker side of this.
Wowzers. Not financial advice. Do your own research. All the other disclaimers. This is for entertainment purposes only, but sounds like something to look into for sure, man. Well, hey, CJ, I just want to thank you so much for joining me again. You're just an absolute wealth of knowledge on a variety of topics. It's honestly, you mentioned having 6,000 followers. Like, it's crazy you don't have a lot more. I'm going to do my best to clip this bad boy up and get those pieces sent out, because this is just jam packed. I hope a bunch of people make it to the end here. Anybody who's watching, thank you. But thank you for your time as always. Again, I hope we can grab a drink at some point, shake each other's hand, and but let's keep in touch. Is there anywhere you want to direct people for People's Reserve or anything else?
Yeah, well, hey, thanks again for having me. It was a blast, and I'm already looking forward to the next one. You know, we were talking about earlier, time flies. So I'm sure another year I'll fly by before we even know it. And I just appreciate you and what you're doing for the community, getting people out here and bringing people and encouraging them through knowledge and understanding. And that's so important for this industry, because a lot of that number, they say the number go up technology. You came for the number go up, but we stayed for the revolution. And you play such a big role in teaching people about the revolution. And it's going to come a little bit faster than I think people are anticipating. So thanks for having me, and thanks for letting me speak on that. If you guys want to follow me, you can follow me at CJ Constantinos on Twitter and YouTube. People's Reserve, we've been building stealth. We're going into beta in August, so just keep your eyes out. I think there's going to be a lot of opportunity around this business. Of course, I'm biased, and I could be completely wrong, but I think the math is there. The math supports us, and I do believe Bitcoin is the most pristine form of collateral in the world, and the largest market makers in the world are going to no longer recognize governments as the least risky counterparty. Instead, those of us who hold Bitcoin, who hold true wealth and equity, will be the source of demand for risk-free rates of return. So thank you so much, and thank you to everybody out there who follows along.
All right, brother. Take care.